Hello everybody and welcome to our reaction video. Today we're going to be watching the Fed meeting and we're going to react to all things on the Fed. I'm Ryan Ricci as always, and we're joined by actually Ish this time on our crypto team.
That's right. Great to be here.
Great to have you. We will just jump right into this.
Good afternoon.
Good afternoon.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
Okay.
The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal.
All right, we will pause it there. I think we actually have, it should almost be like a new segment of what is the cumulative inflation since the pandemic. I mean, we've actually done it every single time he's done this, so we're going to start right there once again. So here we are. Basically, so since inflation, they were calling it transitory in 2021, inflation has gone up 21% since then. So
It'll go away, right?
no, it will not. But really, the main point is when he's saying inflation's coming down, he's talking about the rate of change, but the problem is like once inflation happens, you can't just like take it away. Like it's happened. And it's there, and it's going to stay. And then it keeps building and building on itself. So right there, he is saying that he did a good job, I guess. But the problem is he didn't. We'll go to slide 2 here. We're starting to just call this the real inflation, which is M2. M2 is even worse. So M2 was up 38% since the pandemic, which I really believe is the real inflation on the people, because that's ultimately it's the supply of money. So if the
Purchasing power.
Exactly, it's all purchasing power. If there's a lot more dollars in the system, and you didn't make that much money in that time, you have less dollars, and therefore,
Yeah.
I really think that M2 is the real inflation until somebody comes up with a good reason why it shouldn't. But that's what we're going to do right there. And we're just going to keep rolling this clip as he keeps going.
Strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter.
Okay.
Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened.
Well, so we're just going to pause it here. We'll go to really, he's just going to say for the next about 10 minutes, not less than 10 minutes, about 3 minutes, basically that the economy is fine and essentially,
And it's all good.
And it's all good, which makes you really wonder why did he cut rates. But I think really we'll go to slide 3 here. So just so everybody knows, he cut rates on this meeting. He cut it by 25 basis points. So what does that mean? So our rates, you can see them here. It's the black line, okay? They were at 5.5%, and then he cut it by 50 basis points to 5%, and he cut it by a further 25 basis points to 4.75%, okay? So basically, he's cut a cumulative of 75 basis points. So basically, that's an easing of it. So when rates come down, what you would expect is things get easier for people. And so if things get easier, they spend more. If you spend more, inflation tends to go up.
It's like loosening the money faucet.
Exactly. He's opening the faucet of money, and what happens when you open a faucet of money? More money comes out. More money comes out. More inflation. That's essentially what he has done. And I put the blue line there just so people can see like what mortgage rates. Like mortgage rates are based off of this rate almost. And so, but just so everybody's aware, so mortgage rates did come down a little bit, and right. He cut his rates, but it is also important to know the mortgage rates have started to actually go back up. And so what does that kind of mean? is that really like Powell and this whole thing, like they're not really, the market is telling them when they should be cutting and not cutting.
Right.
It's a lot less like, okay, he cuts and then everything reacts. Everything's front running him.
It's the most reactionary Fed policy possibly ever.
Yeah, exactly.
Yeah.
Like it's all reaction. Like that's what people have to really understand. It's all reactionary, everything about it. And so, really, if you want to know what he's going to do next, you just watch.
Watch the data. That's what he's
You
doing.
watch the market. Is really what you watch. A little bit of the data, but you're watching the market, and that'll tell you what he's going to do next. So with mortgage rates and other rates going up right now, that's definitely something to watch out, because that would almost mean, oh, he may stop cutting rates and in fact need to raise rates in the future. And we'll get more into that as we go on. We're going to skip to time 125 here and a little bit ahead.
In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms.
And we can pause there. I don't know if you caught what he just said there, but he said labor would be even better than where it is now if it wasn't for a storm.
So the hurricane is at fault.
Not even at fault, I wouldn't even say. Like, yeah, when a storm...
Is he saying that? Or?
No, he's more saying without the storm, we would have even stronger labor. So what we saw was very good labor, as is. Mm-hmm. Without the storm, we would have even better labor. So the question becomes, if labor's good, why are you cutting?
It's a good question.
Right? So, like, because if you're going to cut, that means labor's going to get even better and inflation's going to get even higher. Mm-hmm. So if you're saying inflation basically is there and the economy is doing well and labor's doing well, all this stuff is doing well, you shouldn't be cutting, right? You should maybe be raising, at least keeping it flat, but typically you're cutting when people don't have jobs, employment's going through the roof, people aren't spending any money, and you're cutting so you can stimulate the economy. But this economy's already fine, and he's cutting, which just means you're going to further stimulate the economy, which means you're going to further...
Like, you're going to backtrack from where you want to be, which is where you're saying you are now, right?
Exactly. And so you're almost at, like, this launch point. It's almost like, think about it. Currently on inflation, we're at 2.4%. Is your current level of inflation. So if you're going to cut, you would expect inflation to go up from there. So if you're at 2.4, up from 2.4 is not his goal of 2%. Right? It's a very simple thing. 2.4 is greater than 2.4.
So
or no, 2.4 is greater than 2, sorry.
Yeah, what are some like potential reasons he might have to cut if it's not getting towards the targets, which we're already close to?
It makes no sense. Like, this whole thing, he's basically saying, I have no reason to cut, but I'm going to cut. So why is he cutting? I honestly, it boggles my mind every time, because it simply does not make sense. I really just think they're the worst forecasters that this world has ever seen on inflation.
Definitely. Oh, definitely.
And so,
throughout this whole thing, he talks about how they don't try to forecast.
they do that too. I'm sure we'll get to one of those clips as well. I mean, it's like it boggles your mind. Like, if you're like, just wait maybe until inflation's at, I don't know, 1.5, 1.8, and then you cut, and then it'll go back up, and it's going to go back up towards 2. If that's really what your goal is here. So, like, just by them saying that, it just doesn't make sense. And then also, it's kind of important. Well, actually, we'll get to that. We're actually going to skip ahead first to minute 358 here.
To both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.25 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market and will continue to enable further progress on inflation as we move toward a more neutral stance over time.
And we'll pause it there. I'm just calling bullshit again.
It just doesn't make sense.
It doesn't make any sense. You are at 2.4 and things only go up from here. And it's also very simple. Like if you just look at like a Bloomberg estimate for next month's inflation report, it's 2.6 for next month. 2.6 is greater than 2.4.
And both are greater than 2.
And both are greater than 2. So even the market has inflation going up from here. We have it going to like 2.66, or whether it's 2.66 or 2.6, who really cares? It's going up, and that's what matters. And so it really just boggles my mind. So everybody knows it's going up, but you're going to cut, and then what? And then what? Because inflation, once it happens, you're screwed. Like, you can't take back inflation.
Right, that's your new baseline, right?
Exactly.
And then you're just adjusting the rate of inflation beyond that.
Exactly. And so, but all these policy things have lags. So when you do this, you're actually like creating this, it's close to a butterfly effect down the road.
Yeah.
That you basically is what they saw in 2021, where they were calling everything transitory, and it just ballooned and kept ballooning and kept ballooning, and then here we are. And so it doesn't seem like they learned a single lesson there. And we're probably going to skip ahead again towards 610.
Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Okay.
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment, and price stability. We don't guess, we don't speculate, and we don't assume. Now,
right,
just in principle, it's possible.
Okay, so I think ultimately what he just said is that there is no effect. So basically, with the new people coming in, there is no effect that's going to be placed on him in the near term.
Very near term.
In the very near term, so we're talking the next 2 to 3 meetings. Okay, maybe 1 to 2. Okay.
Yeah.
But basically, there won't be an effect. So what does that tell us? So in the near term, he's about to make a policy mistake, and it's going to be bad, which is he's going to cut. So he already cut 50 basis points. He cut another 25 basis points, and the new people coming in aren't going to impact his decision at the December meeting, of which is we'll get to it a little bit later. But it's starting to look like he's going to make the policy mistake of he's going to cut. So in the near term, everybody, it's very important with the election. It's not making any impact on him at all, and he's going to do whatever he does, and all he's ever done is misforecast inflation.
Right.
So
and do you imagine that like the new administration would disagree with cutting again?
So we'll talk more about the new administration later. It's a very good question. My quick answer is they think about the dollar very differently than the Fed.
Yeah.
But we'll get into that a little bit later. So write that one down. And so I think next week, everybody, we get CPI. So that's going to be on Wednesday, and that's where we're going to see inflation is going to go up towards 2.6%. And really what you're going to be looking out for there is currently the market's expecting, there's a 50% chance of a rate cut in December. After you get that CPI, you want to watch where like the 30-year yield goes or the 2-year yield goes, right? If it's going higher, then he's probably not going to cut again at the December meeting. If it goes lower and or stays flat, he's probably going to cut at that December meeting. So, because again, he's not the one making the policy. It's the market.
Right.
So that's what you're going to have to watch out for. But we are expecting, everybody's expecting inflation. This is to be the bottom of inflation, and it's going to accelerate from here. And so we'll skip now to this next question from Reuters at 1309. And just honestly, just listen to how, I'm going to say it, how dumb this question is. It is mind-boggling.
Let's hear it.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the two changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress. And in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation the last 3 months?
Not really, no. So let me tell you what
Okay,
we
we
were
can
thinking.
Stop. I mean, just like,
Yeah, just reaching for any guidance here. Like,
well, they're reaching for any guidance, but like they're picking apart every single word.
like literally that one word further.
Are you talking progress, further progress? Are you trying to signal something between the two of
The
those?
rate of change.
Like, holy cow, that's your question?
Yeah.
I mean, it's honestly mind-numbing, a lot of these questions, but that one was, I thought, one of the funniest. And by the way, I think we'll just keep playing this so people can see the response, because that's also as crazy.
I love the response. I
He
know.
just goes along with it and
Yeah.
like starts talking about it, and it's like, what are you even saying?
Nothing.
All right, well, let's watch this.
So the test of gaining further confidence was our test for the first rate cut, right? And so we net that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%.
We can pause it there.
So-
I mean,
I don't know.
you know any words that he just said?
I don't know what he's saying, if anything.
I don't know either. I thought that was just a funny one that we can all laugh to. We'll skip ahead here to minute 21:20 to get a little bit more into some actual questions.
So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Fantastic question. We'll listen to his response here.
So I think if you
About
look
2
at the
minutes.
3 and 6 month, you're quoting the 12 month. So we look at all of them, right? But if you look at 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we look at 12 as well. But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality.
We'll pause it here, and then we'll split this up since it is large. I don't know if you caught that. Well, you're looking at the 12 month. We're looking at 3, 6, and 12 months. And I mean, it's like you're just jumping from metric to metric. It honestly makes no sense. It's like, oh, because the guy's question is exactly what we're asking right now.
Like, why not pause?
What
Or raise?
or raise? Like,
Why
at least
cut?
pause. Why are you cutting? I mean, it's an unbelievable. It's a great question. It's what we're asking right now. And his response is, well, like 3 verse 6 verse 12, and he can barely get over his words.
Yeah.
Right, which means you're not like. You're out of your mind, because at the end of the day, because they're using PCE, and that's at 2.3. Actually, he's saying his PCE, whichever one he quoted, whether it's 3 versus 6 months, it really doesn't matter at the end of the day. He's saying it's 2.3. Well, I think we're both decently good at math. 2.3 is still greater than 2. It is
So
honestly.
yeah, no matter what metric you use, none of it justifies cutting
It
again.
still doesn't even justify it. Even though he's using different metrics, it still has no justification.
Yeah.
And then I think he said something actually really interesting there is they're expecting a couple upticks into year end.
So is he like saying upticks in inflation?
In inflation into year end, he's saying these are bumps in the road, which to me is like, I'm almost thinking, because what we have are 2 more upticks into the year end. That's what we are projecting. Market's projecting the next one. We're projecting a further one from that. And he's saying that you usually see these types of bumps in the road. So I'm almost thinking like there is a high chance he's going to cut, even though we're going to see these 2 next inflation reports be higher.
He's already cutting now, anticipating these 2 bumps. So yeah, I mean.
Well, who knows what he's anticipating? I think they just react, but yeah.
Yeah.
So I think that was a very interesting way he responded to that. Is he's expecting bumps, and we've seen 2 bumps in the past. So so I think he might be expecting these 2 bumps, and I think that was a little bit of a tell that he wasn't supposed to give. Very interesting, but ultimately, right? We're not right. This could change by when the next CPI report comes out, because remember, he's not the one making the policy. The market is. So you have to watch the way the market reacts, and that'll tell us if he's actually going to cut again in December, which would be, well, you'll see inflation go up further from there. But we'll keep playing this clip because there's more good stuff in here.
We saw last year, so when that falls out of the 12-month calculation in February, we should see it thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from?
Listen here.
So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are, market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So,
all right, so we'll pause it there. It's not reflecting current, it's reflecting past. Well, let's start with what real inflation is, M2, right? So that's the supply of money. When S&P 500 is hitting an all-time high, Qs are hitting an all-time high. Gold it was hitting an all-time high about a month ago. Okay, and Bitcoin, all making all-time highs. What does that do to the amount of money in the system?
What does that do? Or,
yeah,
I mean, the money in the system is causing that, right?
I would say it's a self-perpetuating system of while things are making all-time highs, there's going to be more money in the system. Like we go into a brokerage account, and all of a sudden we have a lot more money than we had about, 3 months ago.
Oh, you're talking about spending.
Exactly, because everything's going and hitting all-time highs. So therefore, you kind of know where inflation is going to go because you know where M2 is about to go as well, right? Because it's a self-perpetuating cycle. So it's also really funny because he's talking about housing, all these things that are lagging that, right? Because think about it. If you're making more money, you can pay more for rent.
So.
Right. So all of these things. So really, he's looking at everything that's not the market, and the market is what leads everything that he's about to say.
Right.
And so he's just ultimately he's just looking at the wrong things. So he's saying what he actually sees, but what he's actually seeing is something
that he doesn't need to be looking at.
That doesn't need to be looked at. That should be looked at. I don't know. It's just it's past. It's just the past. And so maybe he will learn his lesson, but I'm pretty sure we are positive he will not learn his lesson. And
Not anytime soon.
not anytime soon. So we're going to skip ahead now to minute 25 to this next question.
Hi, Chair Powell. Craig Torres from Bloomberg. 2 questions today. Did you learn anything about what Americans think about the economy from the election results? First question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. Compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the
so
election.
Pause it there.
Of course.
So we can ask the question.
It was a good question.
And so his question was, did you learn anything? Basically, this is what, did you learn anything from the people in this last election and the fact that they do not like inflation?
Yeah, basically.
And I think we can answer his answer for him, and I'm going to say no.
He didn't learn.
I don't think he learned anything because he's not changing his
He just cut
pattern.
again. They voted, caring about inflation a lot, clearly, and he cut again.
And he cut again, which is going to tell you that inflation is going to go up. And I mean, I honestly, I don't think he's doing it almost on purpose. Like, I really honestly think that they just have such bad models and such bad forecasting that they honestly have zero idea about what's about to come. And I honestly think that that's what it is.
So
I don't think
malicious intent.
I really don't think it's that well. I think he has J.P. Morgan on his phone, which is not good. But I don't think he's. I think he's just. I mean, it's like you're just using the wrong models. And you didn't learn your lesson the last time, right? Like when you just didn't learn your lesson last time when you were calling it transitory inflation went up. You didn't learn from that, and you didn't change your models. You're using the same models. Therefore, you're going to make the same mistake, and therefore, the people are not going to like it again. And so. Yeah, I thought it was an interesting question. We'll skip ahead here towards minute 28:37 to this next question.
Big Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Okay, you can pause it there.
Jeez.
I mean, that was a great face.
What was that about?
Oh, I mean,
He's just
he was so
two
mad.
words uttered in response.
He was so mad.
Yeah.
I mean, and the way he was just looking at, I mean, unbelievable. Great comedy. I do love my
Yeah,
comedy.
it's comedy. I mean, is that what it's supposed to be? Or?
I wish it was. No, these are the people affecting a lot of things, unfortunately. But all right, I'm not going to comment on like the legality part of if they can remove him or not remove him.
I'm not sure.
I'll be honest, that'll play out, and that's, I don't know, I don't do the whole legal thing. I like to take risk in life. But let's just first go to what like she's ultimately talking about, which is their history. So go to slide 4 here. So this is the history that she's talking about. We've talked about it a bunch, right? The blue line is when they use the word transitory, which was used to say that inflation is going to stop and it's going to come down. It's going to come down eventually. The problem is they were calling it transitory from inflation at plus 2.6% all the way up to inflation at up 8.3%. So they were wrong. And so that's...
So she's asking, like, will there be consequences for you for being wrong?
Right, exactly. And that's what that administration is talking about when they're saying, like, this is not good. And they're talking about the Fed's history. That's the history because... And that had a real impact on the people, right? Because inflation is cumulative, and it grew, and it happened. And so I think that's pretty important. So whether or not it actually happens, don't know, but that is the history. But then I do think that there is something that we should talk about, which is maybe the difference between the two different parties and their ideas on money. Now, this is a more longer term forecast, right? We told you what the Fed's about to do in December in the next two meetings, but this is the more longer term thing. So basically MMT. All right, so I don't know, it's called modern monetary
theory.
Modern monetary theory. Yes. Okay. So what is MMT? This is very important for everybody. It's essentially that, okay, if you have a lot of debt, the way to get rid of debt is by issuing more debt. Essentially, like you get rid of your debt by inflating it away. So you basically put yourself in this situation where you just continuously print, and when you just continuously do that, your dollar, so your currency goes down because you're printing a lot of money, so the supply of your money goes up. Everybody has it, and you're causing inflation to it. And the idea is that eventually you inflate away all of your debts.
Right. Is it effectively you have debt, you issue more debt,
Yes.
and you use the proceeds to pay off your current debt, and you just keep rolling it over.
And you just keep doing that over and over and over and over again. And you just keep printing. It's like control, print, keep it going.
And how does that end?
Japan. So Japan's, like, you can look at, like, Japan's debt to GDP is almost like 250% or so. They don't have any real growth anymore. They had hyperinflation. Their currency is constantly being devalued, right? Like, there are real world examples of this happening. Japan's kind of the best one. So it's really ultimately your currency gets devalued so much, and the people see even more and more inflation. That's kind of how it ends. Do eventually you get run out of debt or outprinted? Like,
Maybe we don't know yet.
kind of, but like you're in this situation where, like, there is no real growth in the economy. So that's the MMT. That's what was going on, and that was more Janet Yellen believed in that on the fiscal side. Now the other side of this is the strong dollar approach that we that is more being talked about, which is basically like America first. You need to, like, watch Vivek. He had a real conversation with Keith. So just look up Vivek and Keith, real conversation.
It was great.
And on YouTube, and you can on hedgeyeTV.com, and you can watch it. But they talk about the Fed, and Vivek is now in office, and so basically what a lot of what he talks about is that you need a strong dollar. Like, your dual mandate is kind of silly, like inflation and all this. It more should just be you want a strong dollar, which ultimately means you're putting your citizens first, and you can't have a strong dollar if you have ballooning debt. Like, you can't have a strong dollar if you have uncontrollable inflation. It's just more strong dollar. Like, the dollar should go up in that type of regime where you're putting yourselves first.
A little more sustainable, maybe.
A lot of people
theory.
would say it was sustainable. It's sustainable, and you see a lot more real growth during that instead of like a growth that's just, it's called nominal growth, which is just inflation. Inflation is going up instead, and so that's the big difference. Now one of the big things is that also on the Fed is 80% of the people on the Fed are Democrats. So it's unclear of whether or not they specifically believe in MMT, or there's this more like thing going on behind the scenes that they're not saying. I don't want to get into what they're actually believing. I think they are trying to fix their dual mandate, but I also think that their forecasting models are really awful. But ultimately, I think it's not going to happen on January 1st, where there's going to be this turnover of this idea. I think it's more like in a year, 6 months, you're going to watch this, and this is going to be an ongoing conversation, and people are going to start to point out Powell's failures, and he's about to make another mistake. And so I think it's something for everybody to watch out for, and
think
that'll
there's
unravel over time.
A change in direction coming.
Right, exactly. So that it's like this change in the direction that ultimately is actually not a pro debt situation. It's more like you're focused on your dollar in your currency instead. And so, but that's like, I don't know, a year, 2 years down the road, and that we'll make sure we'll break it down in the show when it happens and as it's happening. But for the meantime, everything for the next 2 months is pointing towards a policy mistake, inflation is accelerating, him cutting and making it worse, and then it's ultimately going to be too late. So, all right, so let's watch one last clip.
Let's see.
We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And the world went through a global inflation shock, and inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is it takes some years of real wage gains for people to feel better. And that's what we're trying to create, and I think we're well on the road to creating that. Inflation has come way down. The economy is still strong here. Wages are moving up, but at a sustainable level. So it's just I think what needs to happen is happening, and for the most part has happened. But it'll be some time before people regain their confidence and feel that. And we don't tell people how to feel about the economy. We completely respect
So we'll pause
what
it
they're
there.
feeling. Those feelings.
So
What an answer.
well, I mean, the first part is literally him saying inflation is cumulative. That's
Yeah.
literally what he just said, and you can't take it back.
No.
He literally just said that, and
He knows.
He knows
At
exactly.
least he knows.
It's so weird. It is so weird. So he said that, and then I'm going to disagree with him on the last part, which is him saying about wage growth catching up. Because, ultimately, really think about how a business works. In order for you to increase wages, right, your business needs to be doing well. So you need to be making a profit. And if you're making a profit, that means a lot of people are spending. Right? So again, we're going to go right back to the supply of money. M2 has to be going up during that time. If M2 is going up, you're going to be seeing inflation go up. And then that's when you get your wage increases at the very end of that. Problem is, the wages won't keep pace with that inflation.
Right.
They have to outpace that inflation. But so he's saying it'll all catch up and people will make wages. No, in order to make wages, you need to see S&P going to all-time highs. If S&P is going to all-time highs, you're going to see the money supply go up quite a bit. And those people without assets are not participating in that.
Yeah.
In that asset prices going to all-time highs. They're just not. And so they're going to be the ones hurt by this inflation that ultimately he's going to be creating because he is cutting at what is perceived to be the bottom of inflation.
Yeah. And it's funny, he said what needs to happen for the most part has happened. He just jumbled a lot of things together in talking about wages catching up. He said for the most part it has happened, but the question being asked was, these people are still feeling the effects. So
right. So it
I
obviously
don't think
didn't.
it has. Yeah.
It obviously didn't happen because they're feeling that effect.
Right.
And that's ultimately that's what we got there. We will be back at it on the next Fed meeting. We do it every single Fed meeting. We do this for you. We'll break it down